Assalamualaikum. We are going to present our case study, and we have choose petroleum industry. The first is Perdana Petroleum Berhad, Perisa Petroleum Technology Berhad, Karimin Petroleum Berhad, and Hibiscus Petroleum Berhad. We are consist of 4 members, and my name is Nur Alifa binti Alimun, and I will present about Karimin Petroleum Berhad. Established in 1989, Karimin evolved to become one of the pioneer Bumiputra companies providing technical and engineering support services in the oil and gas industry in Malaysia. Karimin specializes in engineering, schedule pipe development, procurement, structure piping, fabrication, and electrical instrumentation installation. Karimin has mass complete project value more than RM1 billion, and among their notable portfolio of clients include Petronas Sharigali, Shell, and Nippon Oil. Karimin was successfully listed on the main market of Bursa Malaysia Security Berhad on 10th of November 2014. Current ratio is to measure the short-term solvency and indicate the extent to which the claim of short-term creditor is covered by current asset. Based on the result, the ratio decreasing from 2017 with 2.95 times to year 2019 with 1.48 times. The higher ratio reflects the ability to pay in short-term obligation on time. And for quick ratio, it also known as acid test ratio. It is a measure of the firm's ability to pay in short-term obligation without having a rely on the least liquid current assets such as inventories. Based on the result, quick ratio for 2017 is 2.95 times. In year 2018 is 2.16 times, which is slightly decreased, and for year 2019 is 1.48 times. Higher ratio reflects the ability to pay in short-term obligation without rely on inventories. Okay, we move to debt ratio. Debt ratio measures the proportion of the firm's total debt to its total asset. It is to analyze the long-term financial risk of the company. And as we can see here, that the debt ratio for this company increased to 44.05% in year 2018 compared to the previous year, which is in 2017 with 39.93%, while in 2019 the debt ratio increased to 56.34%. The higher ratio reflects the higher amount of debt to finance assets. Okay, now is time interest earned. Time interest earned measure the ability of the firm to pay the interest charge applied on the debt used. From the result, in 2017, time interest earned in 1.58 times. In year 2018 is 2.16 times. Therefore, we can know that the time interest earned for this company is better than in 2017. In 2018 is better than 2017. While in 2019, the result decreased slightly from 1.48 times. Higher ratio indicates that the firm can meet loan charge and lower risk of default. Okay, now we will discuss about average collection period, where it is to determine the average length of time taken by the firm to collect its debts from the credit sale. Based on the result, in 2017 it takes 7 days, in 2018 it takes 62 days, and in year 2019 it takes 69 days. And we can see here that there is an increment in the ratio from year 2017 to 2019, which show the company having a longer period to collect their credit sale. Higher ratio indicate that the firm has problem in collecting the debt. Next is a fixed asset turnover ratio. This is to measure the firm's efficiency in using its plant and machinery to generate goods or product for sale. From the result in 2017, fixed asset turnover ratio is 0.83 times, in year 2019 is 1.12 times, and in year 2019 is 1.61 times. The ratio is increasing over time, which tells us that a firm effectively and efficiently use their asset to generate revenue. Okay, now we proceed with operating profit margin ratio. We can see that the operating profit margin ratio for this company experienced an increasing ratio from 2017 to 2018. That is, in year 2017 is negative 9.28%, and in 2018 is 2.41%, and decline in year 2009 is at negative 10.07%. Throughout the year, the net profit margin is decreasing, which shows the company is not effective in generating net profit. Higher ratio is desirable as it indicates lower cost of goods sold relative to sale. Okay, now we are discussing on return on equity ratio, ROE. And we can see here the ratio decline from 2017 is negative 2.31% to year 2018 is negative 18.6%, an increase in the year of 2019 to 17.36%. For year 2019, the ratio show better because it is indicate better return to shareholders. The higher the return, the better of the owners. This measures the overall effectiveness of management in generating profit with its available asset. Okay, now the last part is dividend payout ratio. We can see here in 2017 is 0. The result on 2018 is 0, but on 2019 is 0.25. The ratio indicates the amount of current earning available to common stockholder payout as dividend. This shows that in year 2019, the ratio provides an idea of how well earnings support the dividend payment for this company.
Hi, I am Norzarina Bendy Ahmad, and my student number is 2020156171. And I would like to continue the ratio analysis for Perisai Petroleum Technology Berhad. Perisai Petroleum Technology Berhad was a Malaysia company based on upstream oil and gas service provider. It offers a host of offshore service and solutions designed to fulfill a wide range of clients and covering three broad segments, which is offshore drilling, offshore support, also offshore production. The company logo was bring the meaning of shell, which is represent the company assured of standard to the customer. Also, the logo contains three rising waves within the blue water, represent the growth momentum of diversified service offering in the shallow, deep, and ultra deep water environment. Firstly, was a liquidity ratio, which is result in 2017 was 0.08 times until 2019 was 0.04 times. The ratio is slowly decreased follow-up ratio in the previous year, like 2018 also was 0.05 times. That means the low ratio was reflect the ability to pay short-term obligation on time, and in general, the coverage for short-term obligation was worse. Next, quick ratio. Quick ratio by a company was decreased by annually, and it can reflect the ability to pay its short-term obligation without relying on inventory, which is the inventory and prepaid expenses was zero amount, and sometimes half of a company do not have inventory like another company which is a produce a product. In 2019, it is written as 0.04 times, then 0.05 times in 2018, and 0.08 times in 2017. The ratio with less 105 was not uncommon and also not cause alarm beside the worst edition. Next was a leverage ratio, which is include the debt ratio and times interest earned. Company debt ratio was increased to 154.30% in 2019 compared to 122.90% in 2018 and 85.40% in 2017. Ratio was indicated the amount of debt in financial structure, which is mean a higher percentage in associated with a higher risk. It is important to analyze the long-term financial risk, which is for the higher ratio reflect the higher amount of debt to the finance asset. Then, times interest earned based on result ratio in 2017 was 4.03 times and annually decreased to 3.46 times in 2018 and 0.40 times in 2019. It is important to know the ability by company to pay interest charge supply on the debt used. The annually low ratio was indicated company was getting worse and meet loan charge and higher risk of default. Third was an activity ratio. It is include the average collection period ratio and fixed asset turnover ratio. The ratio of average collection period was 13 days in the 2017 and then increased to 81 days in 2018. Also, lastly show 55 days in 2019. Ratio was determined to company measure the average length of times for collect debts from credit sale. Then it is also used to appraise company account receivable that related to credit policy, which is include credit standard, credit terms, and collection policy. Actually, the higher ratio brings a meaning of company problem to collecting data of debt and it worse than a short period of days. There's a risk by company basically generate for sale from result in 2017 was 0.26 times, then 0.19 times in 2018, and so same amount for 2019 and 8. The fixed asset turnover ratio was become low as it desirable to indicate company was getting worse to generating itself from available fixed asset and capital investment. Generally, the low ratio reflect company was not efficiency in generate sales by the service. Fourth, the profitability ratio. The ratio was including the operating profit margin ratio and return of equity ratio. Refer the operating profit margin ratio in 2017 was 135 and then increased to 113 and lastly 11.30% in 2019. Ratio was increased in 2018 and decreased in next year. Basically, this is a measure of operating profit relative to sale and ability to control all costs except interest and tax by operation. The low ratio assumes lower cost structure and will result in a loss profit. Also, the loss ratio indicates worse productivity or production of service by the company. Then the return on equity ratio. It was recorded as a negative in 2017 as 4.59 next in the 1.13 in 2018, also 0.14 in 2019. It will measure the return earned on the common stock or the investment in the company. A negative return was worse return to the stockholders. That's why company was getting lost profit by every year and getting bigger, and the probability to delist from Bursa Malaysia was existed. Lastly was a market ratio. It is a zero amount for the dividend payout ratio and price earning ratio. This ratio was important for publicly traded companies are used in the stock valuation process in deciding securities for investment portfolio, and the result of the company operation was based on market price. Board of ratio interiors was set at 0 to 2017 until 2019. The dividend payout ratio was indicated the zero amount could not provide any idea to earnings support for dividend payment, and furthermore the amount of ratio by current earning was lost and profitability to get a dividend was impossible. Next, the relationship between market price of company share or known as common stock and the earning per share. In general, zero ratio indicates the firm or company price is getting worse by annually.
Hi, my name is Nodarina Binta Maisri. I'm from class MBO F2B. My student number is 2020521135. In this video, I will present about financial analysis and ratio for company Perdana Petroleum Berhad. First of all, company background. Since 2004, Perdana Group has built a reputation for excellent service in its core activity of providing offshore support to a host of clients. The service rendered include work baggage, work boats for onboard accommodation, and work facilities of offshore personnel. Besides that, they provide towing, mooring, and anchoring of non-proper baggage and rigs. In addition, they also provide transportation of drilling, production, and project materials of chemicals. Their vision is to be the leading and preferred offshore marine operator for the upstream oil and gas industry in the regions. Meanwhile, their mission is stay resilient in the business, united we achieve, and together we create core business values to stakeholders. For financial analysis and ratio, first, liquidity analysis. Current ratio. Based on the result of the current ratio, which is 0.13 times in 2017, 0.10 times in 2018, and 0.10 times in 2019, we can see that the ratio in 2018 is decreasing compared to the ratio in the previous years, which is 2017. In 2019, the ratio increased slightly to 0.40 times. Even so, the current ratio for these 3 years is still low, which tells us that the company has low ability to pay its short-term obligation on time. Quick ratio. Quick ratio, also known as acid test ratio, is a measure of the firm's ability to pay its short-term obligations without having to rely on the least liquid current assets such as inventories. For quick ratio for this company in 2017, it recorded 0.13 times and decreased slightly in 2018 to 0.110 times and increased to 0.43 times in 2019. Higher ratio reflect the ability to pay its short-term obligation without rely on inventories. In general, the greater the level of coverage of liquid asset to short-term liabilities, the better. Next, leverage ratio. For debt ratio, here we can see that the debt ratio for this company increased to 66.33% in 2018 compared to the previous years, which was in 2017 with 65.27%, while in 2019 decreased to 30.55%. From the ratio, we can see from 2017 to 2018, it is increasing, which tells us the company is having higher risk, while in 2019, it slightly decreased from the previous year, so the company's risk is a bit lower. Times interest earned. From the result, we can see in 2017, times interest earned is 2.28 times. In 2018 is 2.28 times. Therefore, we can know that the times interest earned for this company in 2017 is better than in 2018. While in 2019, the result increased slightly from 2018 to 0.62 times. This shows that the times interest earned for 2019 is getting worse. Higher ratio indicates that firm can meet loan charges and lower risk of default. Activity analysis. Average collection period ratio. Based on the result, in 2017, it takes 49 days. In 2018, it takes 95 days. And in 2019, it takes 119 days. Here we can see that there is an increment in the ratio from year 2017 to 2019, which shows the company having a longer period to collecting their credit sales. Fixed asset turnover ratio. From the result, in 2017, this ratio is 0.02 times. In 2018, is 2.16 times. And in 2019 is 0.21 times. As we can see, this ratio is increasing over time, which tells us that a firm effectively and efficiently uses its asset to generate revenue. Higher ratio is desirable as it indicates the firm's efficiency in generating sales from the available fixed asset and greater payover from capital investment. Profitability analysis. Operating profit margin ratio. For this ratio, here we can see that the operating profit margin ratio for this company experienced an increment from 2017 to 2019, that is in 2017 negative 88.19%, in 2018 7.94%, and 2019 is 8.44%. Through the year, the net profit margin is increasing, which shows the company is effective in generating net profit. Higher ratio is desirable as it indicates lower cost of goods sold relative to sales. Return on equity ratio ROE. From the result, we can see the ratio declining from year to year. In 2017 is negative 37.63%, in 2018 is negative 8.88%, and in 2019 is negative 2.56%. For 2017, the ratio shows better because it indicates better return to shareholders. The higher the return, the better off the owners. In the next year, which is 2018 and 2019, it is declining. However, the ratio is still worse because it recorded negative for 3 years in a row. Last but not least, market analysis. Dividend payout ratio, DPR. The ratio indicates the amount of current earnings available to common stockholders pay out as dividend. For this ratio, we can see that this company started as 0 ringgit for 3 years in 2017 until 2019. The dividend payout ratio was indicated. The zero amount could not provide any ideas to earning support for dividend payment. Furthermore, the amount of ratio by current earnings was lost, and the probability to gain a dividend was impossible. Price earning ratio. This ratio shows the relationship between the market price of the company's share, common stock, and its earning per share. From the result, in 2017, price earning ratio is negative 0.14 times. In 2018 is negative 0.2 times, and in 2019 is negative 0.01 times. As we can see, this ratio in 2018 is increasing compared to 2017, which tells us that in 2018, this ratio shows better because it indicates better an idea of how well earnings support the dividend payment, while in 2019, the ratio is decreasing. However, the ratio is still worse because it recorded negative for 3 years in a row.
Hi, my name is Muhammad Shaharuddin Beno Azli from Group NBFO2B. My student ID is 2012397855. So today I will present my group assignment, which is I will share with you about the hibiscus petroleum berhad. Okay, let's start with Hibiscus Petroleum Berhad company background. So, Hibiscus Petroleum vision is to be a respected and valuable independent oil and gas company with a focus on conventional upstream oil and gas resources. So, the core mission is for the company to achieve average production of 10,000 a day and a 2P reserve base of 5 MBBLS of oil. And then the strategic mission is to achieve and further reserve through acquisition. Okay, today we will discuss about the financial ratio for Hibiscus Petroleum Berhad. First, we go through on the liquidity. Okay, so I take 3 years as our comparison from 2017 until 2019. Okay, for under liquidity, we go under current ratio. Okay, as we can see from 2017, the current ratio is 0.97 times, which is lower than compared than 2018 is 1.71 times. Okay, for 2019, the current ratio is 1.04 times. Okay, let's go to quick ratio. For 2017 is 6.36 time, but for 2018 slightly drop until 1.46 time, and then continue drop to 2019 is 0.98 times. Okay, let's take a look on the graph for liquidity analysis. For 2017, quick ratio is higher than the current ratio, but for the 2018 is slightly stagnant versus 2019. So for 2018 and 2019, we can conclude that they are doing very average on the current ratio and quick ratio. Okay, now we move to under leverage. Okay, for 2017 on the debt ratio, we can see is 4% compared to 2018 is 8%. And then for 2019, the debt ratio is increased to 9.63%. So every year it keep increasing on the debt ratio. Okay, for the time interest earned, okay, 2017 is 1.41, and then suddenly increase on 2018 5.99 times. Then for 2019 slightly drop to 2.42 times. Okay, let's take a look on the debt ratio graph for 2017 increase to 2018 also increase, and 2019 also increase. So we can see is slightly increase every year for the debt ratio. Okay, for the time interest earned graph, so we can see 2017 is 1.41 and then increase on 2018, which is 5.99, and then drop in 2019 2.42. Okay, let's take a look on the third part is under activity. Average collection period for Hibiscus Petroleum Berhad for 2017 is 34 days, but for the 2018 is increased to 189 days. But on 2019, this company doing well, we reduced to 66 days. So under fixed asset turnover on 2017 is 1.29 times, and then for 2018 is 1.71 times, and then for 2019 is 2.6 times. So we see on the graph for average collection paid ratio is 2017, and then 2018 increase, suddenly drop and in 2019. For the fixed asset turnover, the graph is mostly stagnant, which is for 2017 is 1.29, for 2018 is 1.71, and then increase in 2019 for 2.6. Okay, we move to the next part under the operating profit margin. For 2017, Hibiscus Petroleum Berhad doing 64.37%, and then drop in 2018 to 56.07%, but in 2019 increased to 67.03. So on the return on equity ROE for 2017 is 14.29%. Then for 2018 is 20.46%, and then for 2019 is 18.59%. So we take a look on the profitability analysis graph. So for 2017, so under operating profit margin is 64.37, and then for return on equity is 14.29, but for 2018 is 56.07%, and then for 2018 is 24.46%. Okay, for 2019 is 67.03, and then for return on equity is 18.59%. So hopefully you guys understand my explanation. Then thank you for watching our video, and goodbye. Have a nice day.